radio for a really great future. We're talking real money.
You know, people out there who sell financial products, who write about financial products, who pontificate about financial products know one thing about us. And it's pretty easy to know. We're greedy. It's not one of our better traits, but it's often exploited because we generally want more. And the thing about human beings is we generally want more with less effort or less risk. It's pretty human. Hi, everybody. I'm Don McDonald. This is Talking Real Money, the show about real money and talking about it on the radio on Saturdays on Northwest News Radio in Seattle, and then 5 days a week on the podcast, the Talking Real Money podcast. Tom is on vacation in Europe somewhere. I'm thinking Leipzig, but I'm not 100% because I just don't pay that much attention. So I don't know. I can't remember what day he said what. I know he's going to be in France soon because he's going to Normandy for the whole D-Day thing. You, on the other hand, are stuck with me for a little while anyway, for about an hour. And you can certainly spend some time with me by going to your telephonic device, which these days is either an iPhone or an Android phone, and calling 855-935-TALK. Okay, you might have a landline. I kind of doubt it, but maybe. 855-935-8255. If you're over 50 or 60 or 70, okay, the odds of you having a landline improve. If you're under 50, you probably don't. And who can blame you? I haven't had a landline. Oh my gosh, I can't even remember the last time I made a call on a landline. That's the kind with a wire. Okay, yeah, that's for you younger folks. Anyway, there is a lot of advice that is promulgated online, in the media of various kinds, television, printed, you remember that, and elsewhere. There's also a lot of information given out by big financial firms because there's a lot of money in managing money. It's a very lucrative field. And one of the areas where there is a lot of bad information, really horrific misinformation, is in the area of what are called safe investments. It is a category without great definition. What is safe? Well, in my opinion, absolutely safe means you can't lose any principal whatsoever. And there aren't very many things that are absolutely safe, unless you hold them to maturity. Bank, FDIC-insured savings accounts under $250,000? Yeah, it's about as close as you're going to get. But high-yield savings accounts have a limit, and that limit these days is around 4%. That's about the best you can expect. And then, of course, you'll hear the argument, well, 4% with 3.5% inflation, which isn't an accurate, I don't know if that's an accurate number or not. You're only making 0.5%. But, well, at least you're not losing to inflation like your checking account is. So because those yields are low, there is a lot of information about how you can get a better, safe yield. And I need you to be very cautious when you read these things and you hear these things. Recently, I read a piece that said covered call writing funds were a safe alternative to high-yield savings. And that's just absolute baloney. These things can lose money. They have volatility, albeit not as much volatility as stocks, but that's not a good comparison. And they oftentimes don't do as well as they thought they would do. I've covered call written in my own previous existence and had success for a while, right up until I didn't. And that's the way with most investments. They work until they don't. Another one that I've seen recently and seen touted a lot are non-publicly traded real estate investments. They hold their value, they say. Well, they only hold their value because they're not publicly traded. If they were publicly traded, then the markets would be assigning values and they would be as volatile as any other real estate investment. The thing that makes them appear less volatile is the fact that the money is locked up. You cannot see what the price is day to day. So be aware that there is so much manipulation going on. If somebody promises that you can make more money than 4% per year in this day and age, right now when I'm speaking 2025, if they say you can make much more than that safely, they are probably lying.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
While we share lots of information that we think you might be interested in, the best part of our job is actually discussing the things that you're interested in. And the only way we know that for sure is for you to ask. And you can ask on Saturdays by calling 855-935-TALK, 855-935-8255. One or the other of us is live almost every Saturday unless it's a mega holiday. For example, if Christmas falls on a Saturday, you'll be listening to a best of show. If the 4th of July fell on a Saturday, you'd be listening to a best of show. Otherwise, we're probably going to be here, one or the other. And for the next couple of weeks, this week and next, it's just me, because Tom's on vacation. 855-935-TALK is the telephone number. That's how you get in touch. And we've got lines open for you and tons of time left. So give me a call. And now we're going to go to my home state, Colorado. Joel, welcome to Talking Real Money.
Don, I have learned so much from you. I am grateful. I've got a two-part question that I'd be interested in your comments on.
Yes, sir.
A friend had her first grandchild born last month, and I want to do something for this little girl, and I want to open up either a UTMA or a 529 account for her with Fidelity. I'd like your opinion as to which one of those may be best. And I'm thinking of putting the money into the Fidelity Zero Total Market Index Fund. The zero means that there's no fees attached to that.
Yeah.
And
I'm not a huge fan, by the way, of that. Let me start there, because the zero funds are gimmicks. The Fidelity has total market index funds, a U.S. and an international. Let me just pull. I just want to get the fee, make sure I have it right, because I think it's really super low. The Fidelity Total FSKAX, FS. I just had to find the symbol. KAX that's their U.S. fund, which has the lower fees. The Fidelity Total Market Index, which is just U.S., and its expense ratio is 0.015%. You can't be a lot closer to zero. The difference is, this is the entire U.S. market, while the zero fund is only a portion of it. It's an emulating fund. They make a portfolio that they think will perform just like the index, but you're not getting the actual index, and there's no point quibbling over literally a few cents. I'd get, if I was going to do a Fidelity portfolio for a child, actually what I would probably do is I would probably use this and the international, which is FTIHX, to give you the total globe. But even just doing the one would be fine for a child. And I would use the 529, because the 529 gives more control over what the funds are used for. A UTMA, the money automatically becomes the child's at the age of majority. Now, I know most new grandparents think that their new grandchild will grow up and be the most perfect young person ever in the history of the world. But I also know that I was a horrible teenager, and if someone had given me a bunch of money at 18, it wouldn't have been a good thing for me.
Okay. That makes sense.
So I would go 529 because then it has to go for education or other similar things. And the coolest thing about a 529 is that part of it can be converted into a Roth IRA for their retirement.
I didn't know that. Thank you.
Yeah, that's a huge benefit.
Don, I appreciate your comments very much. Thank you.
Well, thank you so much for listening, and keep calling, keep listening. Take care, Joel. 855-935-8255. And now we're going a little east of Colorado to Missouri. Randy, you're on. Welcome to Talking Real Money.
Hi, Don.
Hey, Randy.
I'm 69. Hello.
Yep.
I'm 69. My wife's 64.
Uh-huh.
We hear all the time that you're supposed to have long-term care coverage, but very seldom do you hear what vehicle to use to get the coverage. I was just wondering what you suggested for that.
Yeah. Guess what? I'm going to join you at 69 next week, and I don't have long-term care insurance, and I probably never will because it's ridiculously expensive, and the benefits are pretty pathetic.
That's what I've run into so far.
The reason for that was a period of high competition and incredible, overly optimistic forecasting by insurance companies in the past, and they've now, like most things, they've overcorrected. And so you get insurance, you can get insurance, but the benefits are going to be tiny, like $100 a day. Come on. You can't go anywhere for $100 a day. Or they're tied to some other insurance policy that is not worth buying but makes the salesperson a big commission and really provides little to you. My belief is that if you plan ahead and if you build wealth, that you are your own insurance. And that means you have to be willing to accept a dramatic change in your lifestyle should something happen to either one of you that requires really long-term care.
Okay.
There are no good options. There really are no good options. It would be like buying... the problem with long-term care insurance is the fact that we're living so long and that care is getting so good. So to make it worthwhile, it's going to take a ton of your money right now because you're getting into that high risk category. When you're approaching 70, now they're starting to look at the actuarial tables and go, yeah, if he keeps living, he's going to be expensive. So they're not going to give you any kind of deals on these policies. So either it's really what it boils down to with all insurance. You are gambling with an insurance company. They know the odds better than you. They'll win. It really comes down to how much is peace of mind worth to you. If it's worth a lot, then you're going to pay up. Don't go for these hybrid policies because they cover almost nothing. They're gimmicky. We have all kinds of issues with them. We've even had some relationships with people in that industry that have gone sour because we couldn't find anything good to say about them, these hybrid policies. Of course, because they're created by the insurance industry, again, to improve their odds of making money and reduce your odds of getting anything out of them. So you're going to have to pay up, and I mean pay up to the tune of tens of thousands of dollars a year, probably for the two of you, or 5 figures at least for the two of you, to get a policy that's halfway decent.
And how hard is it to prove that you're actually eligible to collect?
Depends on the policy. Just like with health insurance, some health insurance policies are horrific. Doctors have to jump through hoops to get any kind of prior authorization. Others are far more generous, but they tend to be the more expensive policies. So it's a matter of shopping. You're generally going to find the more expensive ones tend to be the better. But they're not cheap. They're not cheap, and you're going to find it really depends on so many factors. I can't even quote you a number because they're going to want to know everything about your health. They're probably going to, even at your age, want a health check of some kind. So it's going to be a bunch of shopping. And
you're calling us old.
We are. I hate to say it. I hate it.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Here's the thing about long-term care insurance. It's really tricky. For example, if you're a male and you're about 70 years old, which is what 69 is, to get just about $150,000 of coverage, and this is a really, really, really loose figure. 150,000, by the way, that's probably in most facilities a year and a half. You're going to pay about $5,000 a year. And if you want an inflation adjuster, you're going to pay $6,000. If you want coverage that could cover you really long term, past a couple of years, now you're getting into the 5-figure range. And if you're a woman, it's even worse. If you're a woman in your 70s, you're for a year and a half, you're probably already at about that $10,000 level. This stuff's expensive. It's expensive. And by the way, the older you get, the more likely you are to be turned down, just flat turned down for any kind of health issues. They're gonna look for a way to not insure you because they don't want to pay out. That's the whole thing about insurance. Paying is bad for them. It's good for you. It's bad for them. 855-935-TALK is our phone number, 855-935-8255. And Bill in Tacoma, welcome to the show.
Hi, Don.
Hey, Bill.
I've got some cash to invest. I have a disabled daughter, and my retirement is fine, but I'm trying to fund her life going forward. And I'm thinking about using a Charles Schwab Intelligent Portfolio. It's a robo-advisor.
Of all the robos, it's probably my favorite because it does do a relatively good job. The minimums are low, and the only real cost is that you've got to keep some money in cash, which isn't a bad idea. It just is cash that doesn't pay as well as other cash might. But it's a small price compared to some of the other robos that cost you, 0.5%, 0.75% when they charge basically nothing. It's you're getting into ETFs and they build and rebalance portfolios for you. So I think that it can be very good.
I actually looked at the cash part of it and thought that was a way to get an income out of the intelligent portfolio. You can
have it go into the cash account. Yeah.
Right. So if you have $100,000 in the portfolio and there's $10,000 in cash, you can withdraw $1,000 a month, and then they will rebalance the portfolio to build the cash up, and then you're gradually decreasing the principal. I realize that.
Yeah, no, and that's actually for someone who needs an income. That makes that cash holding less of a detriment. The only time I see it as and it's such a tiny detriment. The only time I see it as a detriment is for those who are trying to build wealth, not draw wealth. And if you're building wealth, having that much cash can be a drag on your returns. But in this case, it might be the perfect scenario in your case.
So some of this cash is from a sale of a property, and I'm wondering, is now the time to be dollar cost averaging into the market?
Where is the money right now?
Cash.
Put it in the market. It's never a good time to dollar cost average cash into the market. The only time it's a good time to dollar cost average is when you're earning money every month and you're putting a little in. Right. You're dollar cost averaging. Okay. But if you dollar cost average cash, what that says is, I don't think this is a good market. Well, you don't know that, and we do know that about 75% of years are good and 25% are bad. So your odds of being in are better than your odds of being out.
Thank you, Don.
You're very, very welcome. Thanks for listening, and thanks for calling. 855-935-8255. So easy, and so free, and so much fun for me. Hopefully fun for you, but really fun for me. I do love doing this, or I wouldn't have been doing it for as long as I've been doing it. We'll be back in a minute. Don't go away.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Hi there, Don here, talking real money with you again. Not here this week, Tom. He's talking real vacations. And he does them so well. He does vacations right. I wish I did vacations as well as Tom does vacations. I just stink at vacations. I don't do them well. I'm not good at vacationing. I just like to be doing stuff and working, so I don't do well. Plus, I'm cheap when it comes to vacations. I just am. Never get really fancy hotels, and I feel guilty if I buy a first class seat on a plane. I just do. I do it sometimes, but not as often. I feel guilty. Anyway, 855-935-TALK is our phone number. You want to talk about money? This is the place to do it. Every Saturday on Northwest News Radio from noon to 2 Pacific, 3 to 5 Eastern. 855-935-TALK. Let's go down to Lincoln, California. And John, you're on.
Hey, yeah, you were just talking about 529s, and I'm just getting ready to set up a 529 for my 2-year-old son. I'm just wondering if that should be under our trust or in our trust.
That may not be a bad idea. And it can be. Almost all 529s allow a trust as an owner. And there are certainly some estate benefits to having it in a trust. So if you haven't established it yet, then it's establishing it with the trust as the owner may be a very smart move, particularly given the fact that you already have a trust. So there's no cost to establish the trust.
Okay.
You already have it. It's easier to do it ahead of time because transferring an existing one to a trust can be kind of a headache. But doing it from scratch, easy breezy.
Gotcha. And then do you have any recommendations on providers of the 529s? I've been looking around, and I think I'm – go ahead.
Are you Utahing? That's my favorite. I think it's Utah.
That's where I'm leaning towards. I'm in California, but I'm leaning towards the Utah My 529 account.
I love the My 529. I love the fees. I love the fact that there are some very good vehicles in there. They have a very nice glide path vehicle. The tax benefits that they offer to in-state residents are negligible. I mean, in some cases, they're substantial, but just generally speaking, if I was setting up a 529 today or advising someone on it, I'd say take a look at Utah first. Fees are very good.
Okay. Yeah, it's one additional page to put it into the trust, so I'll make the extra effort and do that.
It's not a lot of work, and I think for your heirs, it could be a much easier process should something happen to you guys.
Great. Sounds good.
Good luck, John. Thanks for taking care of the kids. 855-935-TALK. That's the phone number, and we still have lots of time, just tons of time. And let's go to Kitsap County. Steve, you're up. Welcome to the show.
Hey, thank you, Don. Thank you. Hey, so this is a situation of sounds too good to be true, and always have heard annuities are bad or should fit your circumstance. So I'm a federal employee getting ready to retire, got a lump of money, 580 in TSP, recently attended a webinar for FIBA and started talking to a fiduciary about FIAs. And
Wait. A fixed income annuity?
Yeah, a fixed income annuity that does not require you to get an annuity.
Huh?
That does not require you to get an annuity, but you can take up to 10% out of your account. And that's why I said it sounded too good to be true.
It sounds like an annuity.
Because this specific...
And a FIA, an FIA, it's an acronym for a fixed indexed annuity.
Index. Yes, exactly.
And
that's why I'm
if this idiot,
calling for a second opinion.
I believe the person you're talking to is a liar. I think they're a liar. If they say they're a fiduciary and they're selling a fixed indexed annuity, then they are selling a high commission product. High commission. Here's a question you should put to them. What's the year one surrender charge? I bet it's 9%.
Well, and that's the point.
You can take out 10% per year. What if you wanted to take, the question is, what if I wanted to take 100% out the first year?
Right, then there's a surrender.
Right.
And that's what I...
Did he tell you what the surrender was?
And that's what I'm trying to...
Tell you what.
Yeah, it's the 9, the 8, the 7,
oh,
the 6.
Please, this is too much fun for me. I have a break that I have to take. Please hang on. I want to talk more about this.
Tom and Don are talking real money.
This episode is brought to you by LifeLock. Between two-factor authentication, strong passwords, and a VPN, you try to be in control of how your info is protected. But many other places also have it, and they might not be as careful. That's why LifeLock monitors hundreds of millions of data points a second for threats. If your identity is stolen, they'll fix it, guaranteed, or your money back. Save up to 40% your first year. Visit LifeLock.com/podcast for 40% off. Terms apply.
Your guides to a really great financial future. Tom and Don are talking real money.
Well, welcome back. I'm Don. Without Tom. Just me. And you, of course. 855-935-TALK is our phone number, 855-935-8255. We're talking with Steve. Steve's out on the peninsula there in the Seattle area. And let me guess. I want to make a guess. Is this person in Port Orchard?
No.
No. Oh, darn it.
No.
Thought I had him.
No.
All right.
So
do they have a radio show? Do they have a radio show?
No.
Okay. It's not the person I'm thinking of.
They only work with federal employees. And they're over in the Maryland, D.C. area.
Oh,
okay. This is why I'm calling, because it sounds so. The FIA, first of all, you don't have to take the annuity route. It can just be the 10% limit. You get a beneficiary. They do a 10% match of the transfer in and a guarantee of 3.75 the first year. I understand how the fixed index and like if they make 5%, my piece will go up 3%.
Right.
But it just sounds way too good to be true. It's not an annuity where I don't have any money and I get a set amount.
Right. Okay, see, here's where we're getting into confusion. The annuity that you're thinking about is an immediate annuity. That's where you get a payout every month. That's an immediate annuity. This is not.
That's not what this is.
No.
That's an option for this. That's an option for this, but it's not what I'm doing.
Okay, let me tell you first. This guy, whomever this person is a bald-faced liar if they say they're acting as a fiduciary when they sell you one of these. Because you cannot act as a fiduciary and receive an 8 or 9 or 10% commission on a product, which is what this person will be receiving.
Well, that's okay. I have to look into this more because they sent me stuff that shows that they're a fiduciary and they're not getting a commission when I decide to go this route.
That's absolutely.
So, I have to look into this more then.
Okay, let me tell you, that is I have been dealing with these things for decades. And
I know.
In every single case, there is no such thing as a fixed indexed annuity with a surrender charge that doesn't pay a commission. Now, because it's an insurance product, they're not required to disclose that. They won't disclose the commission. Okay. But I guarantee you they're getting one. That's why they push it so hard. And so what they're telling you is you get a portion of the return of the market with none of the downside risk, right? Was that the pitch?
Yep.
That's a lie. I could say lie without fear because they're lying. You see, if it's the truth, that's the ultimate defense. You realize I'm on the radio and a podcast that they can listen to, and I'm calling them liars. Because I don't worry a bit, because they're liars.
Right.
When somebody's a liar, when they're not telling you the whole truth, and if they're not saying they're collecting a commission, they're not telling you the whole truth. If they imply the return of the market, do you have the name of the fixed indexed annuity product? I can look up the annuity itself.
Yeah, it's Fidelity Guarantee.
Fidelity. Not Fidelity Funds.
Guarantee.
Fidelity. It's Fidelity Guarantee Life.
Not Fidelity Fund.
Yeah, it's F&G Life. Fidelity and Guarantee. Yeah. They
gave me 3 companies to choose from that I would choose from.
Okay, what are the companies?
Well, it's Nationwide and American, and then Fidelity Guarantee.
Okay, Nationwide, American what? There's more to the name than American.
Oh, I'd have to go open up.
Anyway, it doesn't matter. They're all. I know these products. Yeah. I know these products, and I know them well. And I am not 99%. I am 100% confident that the people selling them are receiving a commission. And that right there destroys their credibility.
If that is a fact, I definitely agree. Because fiduciary is supposed to work for you.
Here's what I would like you to do. I would like you to contact the insurance company itself, not the salesperson, but the actual insurance company. Call them up and ask them if the agents receive a commission for the sale of these products.
Okay. Yeah. Then how can they have licenses and everything to be fiduciaries?
They're not. There's no such thing as a license to be a fiduciary. There's no such thing.
Okay.
It doesn't exist.
Okay.
Now, if you are registered with the Securities and Exchange Commission as an investment advisor, then you are supposed to act as a fiduciary. If you are a certified financial planner, you are supposed to act as a fiduciary. You're supposedly required to.
That keyword, supposed to.
But people lie with impunity when it comes to separating your money from your back pocket.
Right.
With impunity. And let me just, if you want to check and see if they're actually required at some time to act as a fiduciary, look up the name of the company selling the product to you at advisorinfo.sec.gov and see if they're a registered investment advisor. Guessing they're probably not. But even if they are, they can be both an investment advisor and an insurance salesperson, and insurance salespeople do not have to act under any disclosure rules to speak of. There's some, not many, not much. As a matter of fact, the indexed annuity industry was originally going to be regulated by the SEC. They spent hundreds of millions of dollars lobbying Congress so that the SEC could not regulate them, so that they were only regulated by insurance commissioners in the individual states. It is a terrible system. It is a generally horrible product, and the people who sell them, in my opinion, are just barely above pond scum.
Okay.
Do I have strong feelings about this? Yeah.
That's fine, and I appreciate it because, like I said, too good to be true.
Yeah, and run away from these guys.
Type of stuff. I'm going to have to dig. Oh yeah, I'm going to have to dig some more.
Yeah, how much money were you going to put into? How much money did they want you to put into this?
Well, it was 30. It's 70% of the 580 to be conservative. You know, the
and what were they suggesting you do with the other 30%?
We haven't gotten there yet.
Of course, because they're getting
that was the aggressive.
They're getting the big commission out of the way first.
Aggressive side of it.
Yeah, they're getting the.
Well, but they won't now. I've got to do more homework and research. I'm careful with my money, and that's why it sounded too good to be true. And I was like, okay, wait a minute. I got to get some more opinions on this.
Jeez, this industry, it's so deplorable. Thank you so much for calling, Steve. Well, really.
Oh, no, thank you for the information and stuff. And now I got to do also research on the agency because they tout that they specifically service only federal employees. So
they probably do because that's a little gimmick, but they're not approved by the federal government. They're just using that as a sales tool.
Right, exactly. Yep.
Sales tool.
Yep.
Be careful.
I appreciate it, Don.
Thank you, sir. Slimy people. 855. No, don't call. We're coming up at the break, so don't call. We'll fit one more call in before the hour runs out. We got to take a quick break, though, because it's a radio show before it becomes a podcast. That's why, by the way, if you're listening to the podcast and you go, well, wait a minute, some of their podcasts have no breaks. Well, that's the ones we record not on the radio. The ones on the radio, of course, being on the radio, have to take breaks to pay the bills and do traffic and stuff. So we'll be right back.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Yeah, I think I know who this is. I've been doing some looking. They provide an annuity guide for federal employees. Be careful, folks, please. 855-935-TALK is a number to call on Saturdays. Call us on Saturdays to talk about money and stuff. And let's sneak in one more before we have to go away for the hour. And Evan in Cleveland, welcome to the program.
Hey, Tom or Don, I'm just calling to wish you a happy birthday.
Oh, thank you. Thank you. In my dotage.
You're very welcome.
Okay, well, that's it? That's all you got?
That's it for me. Thank you.
Thank you, Evan, for the kind thought. I appreciate it a lot. And
no problem.
I really appreciate you listening. Take care of yourself. And thanks to all of you, by the way. I really, truly mean it when I say I appreciate you guys and all you've done for me over the many decades I've been doing this. And hopefully I'll just keep doing it because I really like doing it. With or without Tom, although it is fun with Tom here. But he's taking a break with his family, and he'll be back in, let's see, not next weekend, the weekend after. So in the day after the 4th of July, the 5th of July. Of course, the day after the 4th of July would be the 5th of July. Anyway, thank you so much for listening and for being there and for telling friends and for the nice reviews that so many of you have left lately. Thank you so, so much. Really do make my day when you say those nice things that you've said. Thank you. And if you have questions for us, as I've said, you can call us on Saturdays, every Saturday, at 855-935-TALK, or you can go to our website, which is talkingrealmoney.com, and then you'll see it says Contact Us. In fact, there it is right there, down at the left-hand side of the page. Hit that Contact Us button, and when you do that, you'll see you can type a question, or there's a button on the left-hand side that says Start Recording. And you just speak your question, and then those get answered on the Friday Q&A podcast that I do. The typed ones get answered all over the place, and we appreciate your input. And we really appreciate it when you tell friends and neighbors and acquaintances about what we do, because the more the merrier. I am going to, my wife and I were just going to sneak away for a couple of days, but of course I'll be here for all the podcasts for my birthday to celebrate that. And thanks for all the kind thoughts. Lots of people have said happy birthday, and I appreciate that. Thank you so much. If you need more help than we can provide in these short snippets of Q&A that we do all over the place, we do want to help everybody. And Tom and I have meant that from the day we started our firm back in 2009. We want to help everyone, which is why we have been one of the few firms that absolutely promise we'll give you some free help. Will we manage your money for free? No. Bad business model. But we'll help everybody with no sales pitch, no cost, no obligation, just some actionable help. All you need to do to get that is something really simple. Again, you go back to talkingrealmoney.com, and on that homepage, which is right here, you'll see just slightly to the right of the far left side a button that says Meet an Advisor. Click on that, fill out the form, and guess what? You'll be meeting with an advisor.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor. Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services. Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.